Hello, my name is Brianna Taylor. The time is now 9:22. It is March the 2nd, and we're just going to hop into this media readiness assignment. This page here is just instructions and values that we'll be plugging into all our different journals and ledgers and templates. So with our journal entries, we have entries 1 through 11, as you can see, and I'm just going to read out maybe 1 through 4 so you guys can get a feel of what we're doing. The first one is $200,000 worth of MR machine and it's purchased in cash. So when we think of supplies that will benefit our company, we would do assets, but in this case, the asset category is buildings and equipment or plants and equipment. So we start with cash first. It costs $200,000, so we know we're paying that, so we know that's $200,000 we're losing. So that is credited to our account. That is why it is on the right side of the T account. Just running through another one, we have number 5, a patient discharged who used $25,000 worth of inventory. So we know inventory is an asset, and we know expense is also an asset, but in this particular case, our inventory is decreasing. Our asset is decreasing, so the $25,000 is on the credit side because we know we're losing that. And the inventory expense, our debit would go up. Another example, just so you guys can still, get a feel of it. Bills are submitted to insurance companies in the amount of $120,000 for services rendered to patients. So in general, when we think of revenue, we think of credit. So revenue to $120,000 is credited to the account, and accounts receivable $120,000. Moving on to our ledger. Our ledger is basically where we just balance out the beginning balances and ending balances for the year. So we started with these balances from 2018, and these would, for example, be our 2019. It's pretty simple. You just, based on the numbers you got in the journal entry, you're subtracting and or adding. So for this particular one, we are subtracting $200,000, and that will be the first one because we're corresponding with the entries. Like anything under 11 would be, all right, and hopping back in, one of the key things you need to remember is this formula: assets plus expenses should be equal to your liabilities plus your net assets plus revenue. This is the only way your chart will be balanced. If you mess up, per se, on your journal entries, then nothing else you do will balance, and then you'll have to start over. So make sure you pay attention to the values you insert, what should be subtracted and what should be added. Moving on to our balance sheet, these are the numbers that we got from our instruction sheet I showed you earlier. You use those values to plug into the... And with this chart, you have to remember the only thing that you just don't get directly from your ledger account is the unrestricted net asset. For the unrestricted net asset, you're going to use your last net asset. The last net asset will be the one that was provided from the previous year, plus your revenue minus expenses. Of course, we know our revenue minus expenses would be our net income, so we're going to use this value for that. So we're going to do 500,000 plus 620,000 minus our 70,500, and that's going to get us our unrestricted net asset. And next, our cash flow chart, and we're just going to use that from the yellow chart. I highlighted it in yellow on here. That's what we do with cash flow. So payment to sellers will be like, if we bought something, that's that. Payment to employees would be like wages payable. Payment to insurance would be like prepaid insurance. Anything that has to do with insurance. Payment to interest, like if housing or maybe, for instance, mortgage, you would do that. And then for investing activities, like anything that helps you build your business, like in this particular one, it was buildings and so this chart is pretty straightforward. You just take it from your cash section in your ledger and you start subtracting all your values. So the negative 53, for instance, the negative 200,000 and the negative 10,000 should equal your net increase or decrease in cash. That's how you get the values at the bottom. And using the number cash end of year, that should match the value at the ending balance of your cash column. Moving on to the very last step, which is our depreciations. Each of these have different instructions. Straight line and accelerated depreciation, for instance, have cost minus salvage value divided by useful life. Our useful life in this instance is 10 years. Then double decline and balance depreciation is cost divided by 2 divided by the useful life. Correction, cost times 2 divided by useful life. And then for calculating the sum of years, we're going to do cost minus the salvage value times useful life divided by the sum of years. The sum of years will be like, if it's 5 years, you would do 1 plus 2 plus 3 plus 4 plus 5. But in this instance, it's 10 years, so it's 1 plus 2 plus 3, and so on and so forth. And that would equal 55 in this scenario. So we just worked out each depreciation accordingly. So for straight line, we are taking our cost, which is 200,000, subtracting it from our salvage value, 25,000, and dividing it by 10 years, and that will give us this 17,500 value. And it will be the same all the way through 1, 2, 3, 4, 5, 6, 7, 8, 9, and 10. And we're going to be adding. So when you add this, you get 35. You add 17,500 to 35, you get 52, and so on and so forth. And this one is pretty simple. And keep in mind, pay attention to this number at the end because all these values should match. Going on to double declining. Double declining is not as easy as straight line. You have to pay attention to what you're doing. Taking your 200,000, subtracting it, multiplying it by 2, dividing by 10, you get your 40,000, which is our first value. So remember, you take that 40,000 and subtract it from your asset cost. In this case, we go back to our 200,000. Once you subtract that, that would be 160,000. Then you multiply that by 2, that's 320,000, and you divide it by 10. And that is how you get the next number. You add those two numbers together, and that is how you get your next accumulated depreciation. Remember, your annual depreciation should be decreasing, and your accumulated depreciation should be increasing. With the sum of years, you take 200,000 minus 25,000, you get 175,000. And you do times 10 divided by 55 for the very first one. And that is how you get 31,818. The interesting thing about sum of years, each time you will have to decrease your useful life. So for 2, it will be 9 over 55. For 3, it will be 8 over 55, and so on and so forth. Similar to the other columns, you would do your, for instance, 31,818 plus your 28,636 to get your 60,455, and you would do that throughout each column. And honestly, that's it. I would take my time going over all the steps, make sure your calculations are correct, and check your work. Everything should balance out. And that's it. All right, thank you. That concludes my presentation.